Welcome to the Deep Dive. Today, we're looking at something pretty incredible, a surge in market value, like over $1 trillion, just from key AI players. We're talking OpenAI, Nvidia, AMD, Oracle. It's just this astonishing amount of paper wealth created almost overnight. Honestly, it feels a bit like watching a magic trick unfold. But here's the thing, the paradox that jumps right out at you. Where is this trillion-dollar boost actually coming from? It feels, I don't know, really circular. You know that old analogy about the car dealer lending you the money just so you can buy their car? It feels kind of like that. We're seeing OpenAI valued at $500 billion, sure, but losing, what, $2.5 billion on maybe $4.3 billion revenue last year, signing deals for about $1 trillion. I mean, you put those numbers next to each other, this doesn't quite add up, does it?
No, it doesn't. And that contradiction, that's really what we need to dig into today. Our mission is to unpack these really complex financial deals. You called it a merry-go-round. Some might say Ouroboros, the snake eating its own tail. That's what seems to be driving this massive AI boom. We need to figure out exactly how this loop works, and maybe more importantly, look back at history. What can we learn? Especially those warning signs from previous tech bubbles. Are we seeing something genuinely new here? Maybe the biggest investment boom ever? Or is it just, financial musical chairs on a grand scale?
Okay, let's try and get our heads around the scale first. $1 trillion. I mean, OpenAI has signed deals for computing power, reportedly enough to power 20 nuclear reactors just for 2025.
Yeah.
That's staggering, especially for a company that, let's be honest, isn't focused on profit right now.
Exactly. And when you spend that kind of money, the way you finance it has to be, equally massive and pretty creative, frankly. Let's start with Nvidia. That deal really kind of sets the pattern for this circular finance idea we're exploring. So OpenAI needs the best chips, right? Nvidia's the main supplier. The deal gets announced, huge news for a deal. OpenAI pays Nvidia up to $100 billion for chips. But, and this is the crucial part, the twist, Nvidia also agrees to invest up to $100 billion back into OpenAI over the next decade.
Wait, hold on. So they announce a $100 billion sale. The market here is massive demand, infinite growth. But the seller is basically giving the buyer the money for the purchase. How does the market not immediately see that and go, hang on, that's just moving money around?
Well, that's the fascinating part, isn't it? The market seems less focused on the net cash flow for Nvidia and more on the signal. The signal is huge demand from a massive player like OpenAI. It doesn't seem to matter how it's financed in terms of market reaction. The perception is just. Demand is through the roof. Nvidia is essential. And that perception, that belief in the future is what sent Nvidia's valuation soaring even higher.
Right, okay. And just when you think that's peak creative financing, we look at AMD, Nvidia's main competitor. You mentioned this deal is maybe even more complex. OpenAI agrees to buy, $300 billion worth of AMD chips? That's triple the Nvidia number. So what's the catch here? What did AMD offer back?
This is where it gets really, really interesting and frankly a bit mind-bending. In return for that massive $300 billion purchase commitment, AMD gives OpenAI warrants. Warrants to buy up to 10% of AMD itself.
Okay, warrants. So the right to buy stock later.
Exactly. The right, not the obligation, to buy AMD stock at a set price, the strike price. And get this, the strike price was just 1 cent per share. This was at a time when AMD stock was trading around, I think, $204 a share.
1 cent on a stock worth over $200. That's not just a right. That's basically free money if the stock doesn't completely collapse.
Precisely. It's practically a guaranteed profit. So the mechanism is brilliant in a way. OpenAI can exercise those warrants, sell the shares instantly at the market price, and then use that cash windfall to, you guessed it, pay AMD for the chips. It becomes a kind of self-funding purchase agreement. And the market reaction, pure euphoria. AMD stock shot up 24% in one day, added $63 billion to its value, just like that.
Incredible. So the financing deal itself generates the money needed to fulfill the buying commitment, which was the news that drove the stock up to begin with.
Wow. Okay, so we've got the chip makers, Nvidia and AMD, locked in these loops with OpenAI. But there was a third big piece, right? Oracle, the cloud provider. How do they fit in? Right, Oracle's the third corner of this trillion-dollar triangle, if you will. OpenAI signed another huge deal, around $300 billion again, but this time with Oracle for cloud services. And just like with AMD, the announcement sent Oracle's stock flying. It jumped, adding something like $244 billion in market value in a single day. But what's really key here is how it closes the circle. Follow the money. OpenAI pays Oracle for cloud services. Oracle then needs to build out huge data centers to provide those services. What do they need for that? Chips. Who do they buy chips from? Nvidia, mainly. And as we already established, Nvidia is investing heavily back into it.
Okay, I see it now. The same dollar could theoretically go from OpenAI to Oracle to Nvidia for chips and then back to OpenAI as investment capital. It's less like finance and more like, I don't know, a perpetual motion machine for generating market cap. We're talking over $1 trillion in added paper wealth here, completely dwarfing the actual revenues or profits these companies are making right now. So what does this actually mean for you listening to this?
Well, for a lot of experienced investors reading about these deals, it sounds, well, eerily familiar. And this is where we need to pivot to history, because we have seen plays like this before, and they didn't always end well.
No, they certainly didn't. If you zoom out, this whole dynamic feels a lot like 1999-2000, right before the big dot-com crash. Back then, you had telecom equipment companies, the Ciscos of the world, doing something very similar. They were essentially financing their own customers. These elaborate vendor financing deals meant customers could buy more gear, which made demand look like it was exploding organically, but it was manufactured. And when those customers couldn't actually generate the cash flow to pay back those loans, the whole thing imploded. The NASDAQ crashed, what was it, 77%? Took 15 years just to get back to even. That comparison, that's the really crucial takeaway for anyone watching this AI boom unfold.
And you can hear the skepticism from seasoned market watchers. We've got quotes here, like from Jim Chanos, the famous short seller. He basically asks, isn't it a bit odd?
Yeah.
You know, when the story is infinite demand for compute, why do the sellers keep having to subsidize the buyers? It's a fair question. And James Anderson, a British tech investor, also pointed out the certain rhymes these deals have with those old telecom vendor financing schemes. The echoes are there if you look.
Which brings us to the core tension, right? Is this boom real? Is it sustainable, driven by genuine growth that will eventually pay off? Or is it just, smoke and mirrors propped up by clever financial engineering? We really need to consider both sides here, the bull case versus the bear case for these AI valuations.
Okay, let's start with the bulls. Why might this time actually be different? What are the arguments that this massive investment is justified, that it's sustainable? Well, first off, the companies involved are different. We're not talking about tiny dot-com startups with no revenue. A lot of the spending, the backing, comes from giants like Microsoft, Google, Amazon, Meta. These companies have enormous free cash flow, diverse businesses. They can actually afford these bets, unlike the speculative startups back in 2000. Second, adoption is real. It's not just hype. You look at something like ChatGPT. Our sources say it hit 800 million weekly users. That's up from 500 million just months before. That's a tangible, massive user base creating real demand for compute power. You can't just dismiss that. Third, there's the argument from leaders like Sam Altman at OpenAI. He basically says, look, this level of compute power is necessary to even get close to artificial general intelligence, AGI. They have to make these huge bets now, get ahead of the curve. Otherwise, they risk being completely left behind. It's an existential investment for them. And finally, look at the market weight. Nvidia and the other big tech players, the so-called Magnificent Seven, they make up over 35% of the entire S&P 500's value. This isn't some fringe part of the market. This is the market backbone now. It's not just a few speculative stocks.
Okay, those are definitely strong points for the bull case, absolutely. But then you have the bear case, which forces you back to the uncomfortable math at the heart of it all. Let's circle back to OpenAI's finances specifically. They're reportedly losing around $10 billion a year right now. Yet they've committed to spending $1 trillion over the next decade through these deals. We saw one analyst, Gil Luria, put it very bluntly. He said, OpenAI is in no position to make any of these commitments. The numbers just don't seem to support that level of spending, unless you assume absolutely astronomical, near immediate profitability scaling up, which makes the commitment feel like an enormous gamble.
Right, and that gamble leads directly to the second big worry for the bears. What about the return on investment? What if AI adoption slows down? Or maybe worse, what if companies adopt it, but it doesn't actually translate into profits for them?
Yeah, and there's some pretty sobering data coming out on that front. We saw, for instance, an MIT study suggesting that something like 95% of organizations are getting zero return from their generative AI investments so far. Zero. And a McKinsey report found something similar. 8 out of 10 companies aren't seeing any significant impact on their bottom line from AI spending. So if that promised productivity revolution doesn't happen, or if it's much further off than people think, then that guaranteed demand that's fueling this whole trillion-dollar cycle, the demand currently being subsidized by the sellers, it could just evaporate. And if that happens, the whole structure could come crashing down pretty fast.
Okay, so let's try and pull this together. We're watching one of two things unfold. Either it's the biggest, most coordinated investment boom in tech history, driven by real need and real user growth, or It's an incredibly elaborate, closed-loop game of financial musical chairs, one that looks worryingly similar to past bubbles. And that $1 trillion in paper wealth that's been created, it just dwarfs the actual realized money, the revenue and profit coming into most of these companies right now.
And that's why this is a moment for, critical thinking, not just getting swept up in the excitement. The sources really highlight a key lesson from market history. When the sellers feel they have to subsidize the buyers, and when the actual economics for the end users look shaky, like the studies showing little to no ROI, that should be a major signal for you, for any learner or investor, to just pause, take a breath. Because if the money's just going in circles instead of coming from real customer value, the foundation isn't really solid, is it?
And maybe the final thought, the really provocative one, comes from Sam Altman himself. He reportedly said that profitability isn't even in his top 10 concerns right now. Now, you can admire that kind of long-term shoot-for-the-moon vision, absolutely. But history offers a pretty stark warning, doesn't it? In financial markets, these circular setups can inflate valuations incredibly quickly. But if the underlying economics don't catch up, eventually those loops turn into vicious cycles downwards. The only question really is when.